Welcome to Investopia-Media. If you are new here, subscribe and hit the bell. Every week, we cover the market events and individual stocks that move your portfolio. Today is April 8th, and this morning is one of the most volatile trading days of 2026. Two massive stories are colliding at the same time, and you need to understand both of them. Story number one, the Iran ceasefire. This morning, President Trump announced a 2-week pause on U.S. strikes against Iran, contingent on Iran reopening the Strait of Hormuz. Markets reacted immediately. The Dow jumped 1,200 points. The S&P 500 is up 2.4%. Nasdaq is up 2.8. And oil, which had been trading above $114 per barrel, just crashed 17% in a single session, down to $93. That is one of the largest single-day drops in crude since 2020. If you followed along with the news last week on Cheniere, Diamondback, and Devon, here is your update. The straight thesis was straight closed, oil elevated, these companies print cash. That thesis is now on a 2-week hold. Diamondback and Devon are pure oil price bets. With crude at 93 instead of 114, the free cash flow picture compresses fast. Manage your size. Cheniere is the exception. The structural case for USLNG from Asia is multi-year and does not hinge on a 2-week ceasefire. But short-term, these names give back gains while the market reprices. Story number two is the bigger picture that has been building all year: tariffs. The S&P 500 finished the first quarter of 2026 down 4.6%, the worst Q1 since 2020. Trump's new tariff package hits all imports with a 10% baseline and up to 34% on goods from China and Taiwan. Tech is taking the biggest hit. 90% of iPhones are still made in China. Nvidia manufactures nearly all its chips in Taiwan, which faces a 32% tariff. Morgan Stanley estimates Apple alone absorbs 8.5 billion in additional annual costs, a 7% hit to net income. The Atlanta Fed's GDP tracker went negative in Q1 for the first time since the pandemic. Here is where it gets interesting. Before this morning, traders assigned a 43% probability that the Fed makes zero rate cuts in 2026. After oil crashed 17% today, that number dropped to 33% in a single session, a 10-point swing. Lower oil means lower inflation pressure. Lower inflation pressure means the Fed has more room to cut. Rate cut bets are rising right now as we speak. That is meaningful for rate-sensitive sectors, utilities, real estate, small caps, and home builders, all up sharply today. There is one more story from this morning that is a perfect real-time expression of all of this: Delta Airlines. Delta reported Q1 earnings today: $423 million in adjusted net income, 64 cents per share. Beat expectations. Stock is up 8%. But here's the context. Just last week, Delta's CEO, Ed Bastian, said the company would cut capacity growth because jet fuel costs were crushing margins. Their fuel bill was running $2 billion above plan this quarter. With oil now at $93 instead of $114, that headwind shrinks dramatically. Delta is the clearest immediate beneficiary of the ceasefire trade. Airlines, cruise lines, and consumer discretionary names with fuel exposure are all moving higher today. My take: do not mistake today's rally for an all-clear signal. The ceasefire is 2 weeks, not a resolution. Iran and the US are still far apart, and tariffs are not going anywhere. The S&P is still negative for the year. Corporate earnings season is about to reveal exactly how much damage the tariff shock is doing to margins. This is a moment to reassess positions, not to chase. The best opportunities in a volatile environment like this come fast and do not stay open. Keep cash ready. Subscribe to Investopia-Media for updates as this situation develops. Drop a comment. Are you buying this rally or staying patient? Hit like, and I will see you in the next one.